Hey, everybody, welcome to Cigars and Syndication, where we're passionate about real estate and passionate about cigars. Today, we're smoking a La Flor Dominica 25th anniversary, and we just lit these up and really enjoying it so far.
Yeah, hi everybody. I'm Junaid Noor. This is a Churchill size 7 by 52, is it? 7 by 52. It's a very good on the start. Peppery, got some cocoa, a little bit of leather, but more pepper and cocoa. And I know that this is a very complex smoke. I've had this before. By the middle of it, it's gonna start mellowing out. But I think this is a 2 episode smoke, isn't it?
I think you're right. I think this is going to be a two-episode smoke. Our topic today is going to be a hot topic. It's going to be about the Silicon Valley Bank and some of the things and circumstances that led up to where we are today.
Yeah, it's everybody's talking about Silicon Valley Bank right now, or SVB. They were founded in 1983, um, and I may be dating myself, but to me, 1983 doesn't seem that long ago. But they're still, they've been around for 40 years, so it's not like they were founded yesterday.
Yeah, no, they've been around since 1983, and I think they originally started off as the Santa Clara Valley Bank, and initially, and then changed their name to the Silicon Valley Bank to kind of suit their customer base a little bit more, and try to cater just to the tech industry.
Yeah, and they basically became bankers to the tech industry when other banks didn't want to deal with the tech industry. They didn't want to be able to provide any kinds of lines of credit, and conversely, when tech startups started coming into fruition, they didn't actually know who Silicon Valley Bank was, and it took a lot of convincing on the part of the three founders of Silicon Valley Bank to get tech startups to come in and start banking with them.
Yeah, it seems like they had a really impressive list of customers from Google to Apple, and it really seemed like they hit the mark when they put their business plan together, and it seems like they at least for a good run had a good strategy.
Yeah, Cisco and Netflix were also some of their customers, and they went public in the '90s, and they were doing pretty well. It was a hot decade. The '90s was a great decade for startups, and even after the 2000 tech bubble burst, um, you know, other tech startups came into fruition, and VCs were still, VCs had a lot of money, and VCs were still putting money in to startups. The interesting thing is that startups don't usually need a lot of debt. They don't usually have a lot of loans. Most all their money comes from venture capital, and the VCs fund those deals, so they're all equity-based deals, and then those funds are deposited into a bank, and Silicon Valley Bank was the premier bank for VCs in Silicon Valley to deposit their money in.
Right, and when we were talking earlier, you were talking about that they did a lot of investing in long-term bonds, and this was to kind of balance out their portfolio a little bit.
Yeah, so they wanted to stay with investing in startups, but when you get deposits from startups, you still have to be able to pay your shareholders out. So what they decided to do was they put a lot of money uh, into treasuries, U.S. treasuries, and because treasuries were giving a consistent rate of return, they were giving interest, and it would smoothen out their returns. And I think they were getting like 1.83% on the treasuries, and the money is just sitting there, right? So startups, as they raise capital, as they need capital, they will deposit funds that they raise in, and then as they need to make their payroll, their research and development, they withdraw funds. So for their shareholders, it was, wow, we've got all these great customers, Google and Netflix, and their newest customers were Roku, and Etsy. those are some of the current customers that kind of got caught in this pickle when the bank failed.
Yeah, no, you've seen that, and you've heard from a lot of them, and their inability to take care of their vendors and customers, and it's pretty scary. I could see where they did have a run on withdrawals that really kind of really put this thing in motion.
Yeah, so we do another episode here on Cigars and Syndication where we explain bond yields. And one of the problems, and you can look up that episode, we're going to link to it at the bottom of the page, along with an article talking about what we're talking about here in the podcast. We'll link to that too on our website at www.albanyparkcapital.com. So going back to yields, what happens is that when you are invested in a bond, a treasury bond. Now, treasury bond again, is guaranteed, right? The U.S. government can print money backed by the full faith and credit of the United States government. So the coupon, which is the face value of the bond, so let's say it's a 2% bond, and you put $100,000 in, you're going to get that 2% interest every year. And if it's a 5-year bond, if it's a 10-year bond, if it's a 1-year, whatever it is, you're going to get that money back. Plus, you're going to get that interest plus the principal, and that's pretty much guaranteed. But what happens is when you need that money before the maturity of the bond, you need to go sell it in the open market. In order to be able to sell it in the open market, if your bond is only paying 2% interest and the government is issuing new bonds, which are paying 5% interest, well, no one's going to buy your bonds.
So when that happens, you have to discount your initial payment on the bond.
Correct. So what will happen is that if you have a $1,000 bond, you're going to have to discount it by 3%. So you're going to sell that bond for $970. If you're going to discount it and be able to balance out the interest rate that the buyer will receive from the bond that they would normally receive if they would have bought a 5% bond.
So basically, they're borrowing short term but investing long term, and then as we talk about in an upcoming podcast, the inverted yield curve caught them.
So the inverted yield curve is one of the issues, right? The market being what it is, that nobody wants their bonds when they can go out and buy better paying bonds, better yield bonds in the market. But there are two other problems. One is the accounting problem, and the second is the regulatory problem. And I think what we'll do is we'll try to dive into each of these in detail as we go along in the podcast.
Well, before we get into those, I think we should talk about this LFD 25th anniversary smoke. It is really complex, and I'm getting a lot of different flavors, and you get the peppery, and it is definitely hitting the roof of my mouth, but I'm getting some sweetness, and it's kind of maybe a little coffee, maybe almost like a little marshmallowy or something. It's really interesting, complex smoke.
Yeah, it is very interesting. It's very complex. It's mellowing out for me, which I kind of figured it would. But yeah, it's a very complex smoke. It's a very good smoke. I'm really enjoying this.
Yeah, myself. It's what is it? What would we say? It was an Ecuadorian wrapper with Dominican binder and filler, and this is the Churchill size. It was a 52 by
7?
7. Yep.
Yeah.
Well, I think what really kind of put this thing in motion was at the end of 2022, they had to report 1.8 billion in unrealized losses on their bonds.
Yeah. So, well, there's a couple of things that just kind of went into this perfect storm. One is that they had a lot of uninsured depositors, right? So these tech companies come in and they put in millions and millions of dollars in their accounts, and the FDIC only guarantees $250,000 per account type, per depositor. So if you have a checking account and a savings account, then you're $500,000 insured. And then if you have a money market account, then you're $750,000 insured. So with some of these VCs that have, 10 and 20 and 30 and $50 million sitting in the account, in one account. Well, if that first $250,000 is insured, the rest of it is not. So when you have a lot of uninsured deposits, and a fear comes out in the market that your bank may not be able to cover, doesn't have enough money to pay you back, and the FDIC won't insure that, what do?
Yeah, everybody rushed to withdraw their funds.
Everybody rushed to withdraw their funds.
Created a shortage at the bank. So then that's when they tried to liquidate their long-term bonds at a loss.
Right. So the other issue that I wanted to talk about is the accounting, all right? The accounting rub. And the accounting rub is that during 2007, 2008, right around that time, there's a governing body called the FASB, the Financial Accounting Standards Board. They are in charge of making the rules for generally accepted accounting principles. Those are the rules that all public corporations have to abide by in order for their financial statements to be audited and approved for use. Okay, so it's a set of rules that everybody shows consistent reporting. So anyway, the FASB pushed through, they fast-tracked this rule, which has been around since, the 30s, but was never really used properly. It's called mark-to-market. And mark-to-market basically means that if you have securities on your balance sheet that you purchased, let's say, a year ago almost, Tesla purchased a lot of cryptocurrency. Okay. And then they made an announcement. Elon Musk tweeted, Tesla's buying crypto. Oh, and by the way, we may even accept Bitcoin for Tesla purchases. So Bitcoin's price went up because now there's a demand for Bitcoin. Well, when Bitcoin fell and it went to $30,000 and then went back down to $10,000, mark-to-market accounting basically says that if it went down to $10,000, and you purchased it for $20,000, you need to show that $10,000 loss as an unrealized loss on your balance sheet. In December 31st, 2022, the balance sheet for Silicon Valley Bank, they had to show unrealized losses for all those bonds that they purchased, which were paying 1.8% interest, but now the yields are much, much lower because actual bonds are paying 5% interest.
So there wasn't a real loss, but from an accounting standpoint, for GAAP accounting principles, they had to report that as a loss on the balance sheets. But it doesn't really happen until the bond is sold. So if they kept those to maturity, the losses may have been a little less.
Right. And so what FASB rules for mark-to-market accounting does is that it breaks up your securities into two buckets. Ones that are held till maturity and ones that are for sale, right? So anything basically that you're going to sell within the year has to be marked down to its current market value, but not marked up. So you can't mark it up. You have to be able to mark it down, though, because one of the rules that accounting follows is the rules of conservatism. So we are conservative about not making the balance sheet look too good.
So no forecasting or anything like that can come into play, but in the fact that there is market loss, you have to show that on the book.
Right, even though there is not an actual loss, but because there's a market loss, we have to show that on the books as an unrealized loss. So, again, the intent was very good. During Dodd-Frank, when Dodd-Frank was passed in 2008, one of the reasons it was passed is because the predecessors, like Enron, right? Enron used crazy accounting. They called it mark to forecast, where they would put securities on their balance sheet, which the value of it was based on forecasts, not even market. And they would just keep increasing those values and keep getting more money off of those, issuing more bonds and issuing more securities off of that because they would overinflate their balance sheets. So the intent was that, well, we want to prevent that. So we're going to require everybody to do mark to market accounting.
Well, I think that pretty much sums up the accounting for the Silicon Valley Bank fiasco that's happening before us today, and we're gonna follow this up with a part two to this and dig into the regulations and the regulatory part of this whole episode.
Yep, and we'll get in a little bit more deeper into the events that were unfolding, and maybe what may have been able to be done to prevent this. But yeah, we'll catch you on the next episode.